What's up everyone, it's Scotty with Money Investing. So in this video, I wanted to talk a little bit about Tom Lee's analysis of the market, and this video is certainly going to be for the bulls. When I say Tom Lee, obviously it's going to be geared towards all the bulls out there. So hope you guys enjoy it and find it helpful. I'm going to break down, what he's talking about in terms of valuations of different sectors in the markets, talking about market breadth, and of course talking about inflation and the market overall, and how the bottom was already in back in October. So again, hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like, subscribe to the channel if you're just joining us for the first time. Don't forget, we've also got a brand new channel called Money Investing Reads that you can also subscribe to and get access to all the book reviews and summaries, and we're going to be covering a lot of different insightful, valuable information on that channel as well. So I would really appreciate it if you could head over there, watch the first video, and of course subscribe there as well. And of course we have the 16% annual discount on our Discord, so link's gonna be down below. That's only available for another 3 more days, and the Memorial Day weekend sale is available on our courses, fundamental technical analysis courses. 60% off, coupon code is gonna be Memorial if you want to take advantage of that as well. So this right here is the research Tom Lee shared about 10 hours ago, or about 8 to 10 hours ago, and they basically mentioned that for most, FANG up 45% this year because earnings delivery has been surprising to the upside. And that's true. I mean, earnings have come out very strong. That's also for a fact that, earnings expectations were already so rock bottom. That's why the earnings surprises were labeled as surprises to begin with to the upside, because earnings expectations were obviously a little bit lower. And again, look, I'm not going to sit here and favor Tom's analysis or try to bash Tom's analysis, but I'm going to share my objective analysis and opinion on what he's talking about, okay? So again, I'm going to try my best to be as unbiased and as objective as possible in this video to kind of go over some of the things, because look, I own these companies, right? I own Meta, Tesla are some of my biggest positions. Tech is really where the focus has been for us, for our channel. We've been covering technology stocks for as long as I can remember. So I'm very much with him, and I'm overly optimistic for the long term. I'm bullish for the long term, but I still have to be objective. I have to recognize risk where there is risk, and be as unbiased as possible, because that's really where I think successful investing lies, is just being objective and not being emotionally attached to one narrative or one thesis. So foremost, FANG up 45% this year because earnings delivery has been surprised to the upside, but again, expectations were really low. Look at Nvidia and Meta and others. Future forecasts of earnings are higher, supporting higher PE and on higher EPS as well. So a couple things there. The EPS was already very, very low, and it's coming off of a low base, and the expectations have gone up. Why? Because of cost cuts, not because of something that these companies are doing revolutionary. Yes, Nvidia's example, we can kind of use artificial intelligence, but for Meta, I can't make the case that I would make for Nvidia. Meta, yes, is using AI to some extent to kind of enable more growth and enhance their productivity and of course increase their earnings. But majority of that narrative change, thesis has changed because of cost cuts, not because of earnings growth here. Nvidia has not. I don't think Nvidia has done any cost cuts, right? They haven't really laid people off. Correct me if I'm wrong, but it's mostly the artificial intelligence that's driving the earnings expectations higher. And then of course the surprise basically happened because expectations were so low to begin with. Now this right here is something that he's also talking about. By the way, those bearish and advising owning defensive stocks, advising investors to buy, quote, expensive stocks, see the semi-contradiction. This right here is what he basically talks about in terms of valuation. So right now he has the S&P 500 at almost 17 times earnings. Okay, right now S&P 500 is at 42. So if you take 4,200 divided by 16.9, expecting EPS of $248, $249. But here's the key part: it's not for this year; it's for next year. So they're looking at 2024 estimates, and they're also mentioning that FANG stocks are worth almost 25 times earnings. We've got discretionary X FANG at 20 times earnings, and then of course we got communication services excluding FANG 10.6. Overall S&P 500 excluding FANG is 15.1, and he mentions X FANG P hardly demanding. But at the same time, you have to understand that the further you stretch out these timelines, like I could look at 2027 or 2030 earnings per share estimates, market's going to be extremely cheap today. But that's based on an EPS of 7 years into the future, right? So the more you stretch out these timelines, of course the P multiples are going to look a lot less than where they are, because you're expecting that growth in the future. But that's that's when it becomes a little bit more of a challenge, right? I mean, you're predicting the future. You're really kind of expecting earnings to grow to $248. That's up down from 225, 230 today. So, that's going to be a growth rate of, let's just see, about 10.2%. Possible, not saying it's not, but it's just that we're using a little bit of a different year to make the valuations look a little bit lower. But if we actually take 2023 numbers, right, which I assume would be 228, 230, around those levels, then the valuation multiple really is around 18 or close to 19 times earnings, which is about fair, right? It's not, yeah, and he's right. I mean, it's not hard. It's not like super high demanding P multiple. It's not considered to be like super overvalued, but it's not cheap either, right? It's about fair, I would say 18 to 19 times. And of course, when you look at FANG stocks, they are trading at 24, 25 times earnings. I did a video specifically on the top 7, I think, top 7 stocks, and they were, I think, trading at 25, 30 times as the average or the median price earnings multiple. And I do agree with him that staples and utilities are still pretty expensive, trading at 17, 19 times. In fact, if you take into account some of the numbers from today for forward basis 2023, they're even higher. He's actually doing them justice by going out to 2024 because that reduces the actual price earnings multiple a little bit because the growth is priced in. But if you take for 2023, excuse me, I think these price earnings multiple are going to be a little bit higher than what they actually are. So this right here is another chart that he shares, which is quite interesting as well. He says, don't wait for the Fed market bottom to before Volcker shifted tactics and tire declined erased in 4 months. Now, this is an interesting chart. What he's really talking about is when Volcker basically was fighting inflation during that time, the markets obviously dropped about 27% or entered a bear market in about 430 days, a little over a year. And then before Volcker even shifted tactics, or before he even pivoted, so to speak, which was again the chairman of the Fed at the time, the market already had rallied, right, quite a bit. The market had already erased those several months worth of gains in just 4 months. So we erased the entire gains. So new all-time highs 1 month after Volcker considers ending inflation war. So that right there is something he's talking about. The don't wait for the Fed. As soon as the market's going to be, really just sensing the fact that the Fed is very, very close to considering pivoting or considering shifting tactics, that's going to be enough. That's going to be enough for the markets to kind of rally higher. And then he kind of draws this, comparison between Volcker and, of course, Jerome Powell. Probably a coincidence, but he's talking about how the markets obviously were selling off 27% 1980s and 2022, another 27% in the bear market. And now we're starting to see a little bit of momentum back up in October. Now, one very interesting detail that they do leave out here is that this was at the final leg of that inflation fight, right? 1980s, this was towards the very end of Volcker's time of fighting inflation, right? We were very much coming out of high inflationary periods. And this is, again, a chart that he shares in another sort of tweet. And he talks about how 2022 bear inflation is the war of the Fed and the economy is fighting. So the chart that we just saw, this one right here, this one, is really just a zoomed in version of over here. This right here is the zoomed in version, right? That's what he's really just talking about in that segment. But obviously we have to put things in context, and that is to say that inflation had a double top and actually was peaked back in even 1974, 1975. It dropped and then it peaked again in 1980, right? So that's really what he referred to in that chart in 1980s is inflation had peaked, it was coming down, and markets were selling off, and then immediately erased all those gains in a matter of 4 months. So a little bit of context is needed, right? Because this was towards the last leg of that bear market, of that inflationary period. Inflation came down and stayed down for good, right? That's the real thesis here, because all the other times, the past couple times, you can see the markets really traded flat. Since 1968 till 1983, I mean, the market didn't really go anywhere. We kind of sold off, pushed higher, sold off, pushed higher, consolidated sideways, pushed higher, sold off again, and then really started that rally towards the end of that cycle. So who's to say that we're not over here, right? We're not in the early stages of this inflationary cycle here, that inflation peaks again and makes a new high, right? That's the unforeseen or improbable or unpredictable sort of a scenario that we don't really know if it's going to happen yet, right? So obviously the comparison being drawn here is that 2022, 2023 is very much like this. like 1980s, but who's to say that it's not like this, right? We're not in the beginning of it. So that's something that I need to kind of address as well, because again, I'm trying to be as objective as possible. I do still think that inflation is on its way lower, and we are seeing some progress in inflation being made. Hold on one second. Yeah, there we go. So I think we're still making some progress on inflation. The only key factor, the only wild card really holding us up is shelter prices. You know, if shelter prices keep coming down, I mean, food prices are making progress. Energy obviously has been making a huge contribution towards this slowdown in inflation. But shelter prices with this huge lag are really what's causing, you know, core CPI, core PCE, and of course, PPI to kind of remain elevated at these levels. And wage inflation is also something to keep in mind because wages are still growing. We're going to find out the average hourly earnings on the first Friday of the month. So that's going to be very important as well. But let me know your thoughts down in the comment section below. And like I said, like I'm still long, I'm still bullish, I'm still optimistic about the market. But I also want to do it in a very risk-conscious way, because the moment we start to feel or believe there is no risk is the riskiest thing you can do. The moment you believe the market has no risk is the moment that is the riskiest time to be in the market. So hope you guys enjoyed this video and find it helpful. My focus is very much going to be on risk. It's always going to be on risk. We're going to talk about risk time and time again. So hopefully I don't kind of, you know, burn your ears out by talking about risk too much. So hope you guys enjoyed this video, find it helpful. Make sure that you drop a like, subscribe to the channel if you are just joining us for the first time. Link to our Discord and Patreon is going to be down below. As always, 16% annual discount available till the end of this month, and the fundamental and tech analysis courses currently 60% off, and that's going to be available for Memorial Day. Coupon code is going to be Memorial, and don't forget to subscribe and watch our first video on money investing reads. There's going to be a lot of videos reported and posted there as well. So always, happy investing. I'll see you all in the next video.